The war in Iran continues to keep elevated volatility in things like oil, and we're going to talk about that today on St. Patrick's Day with our good friend and colleague, Professor Mark Guthner of Rutgers. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest. Welcome to Office Hours with Professor Mark Guthner, who, based on his apparel and the stroller in the background, I believe is not actually in his university office, but is actually in your home office. Is that correct?
That is correct. It's spring break, and I didn't get to go to Florida. Oh well.
Ah, all right. Well, is the weather in New Jersey pretty good right
No,
now?
it's 35 degrees or something. We had a
It's
couple of warm
it's
days last week, and I thought, well, this is going to be great because we got up into like 70, but
yeah.
we
It's gotten
reverted.
quite warm over here. It's gotten, things have warmed up considerably.
Yeah.
I saw you put a couple posts on X about elevated oil prices, about the risks to the Strait of Hormuz, about the risks to the global economy that, continued concern about oil globally might have. I have a chart on my screen right now,
Okay.
which I think we ought to share. Some people may not be familiar with what this is. This is the OVX index, which I'm using a different color palette and some nice thick lines, so hopefully this comes across well. This is essentially the SIBO's equivalent for the VIX index, which many will be familiar with. This is the VIX index being a 30-day forward look at implied volatility on the S&P 500. This is a similar measure of implied volatility for crude oil. And it has fallen back quite considerably from its recent highs. You'll notice that this is just a monthly number. If you look up here, this actually had gotten over 100. It is right now around 95, so that's the level where we find ourselves right here. You can see that actually there's been only one prior instance, and that's right here. It was the pandemic plunge when West Texas Intermediate actually traded negative, partially because of some exchange-traded products where maybe the investors didn't fully understand what was going on. And the other time that we got almost as high as we are now was back in 2008. And for those who don't remember, and actually, you know what I'm going to do? I'm going to put crude oil in here. I wonder if I should put Brent. Actually, I'm not sure if because I'm not sure that the rolling future is actually going to go back that far. So what I'm going to do is, it does not, no problem. I can get this in a different way.
Can you do just
really
West Texas Intermediate?
Yeah, this was supposed to be West Texas Intermediate. It doesn't really matter. What I need to do, though, is the historic data for Bloomberg only goes back so far. So what I actually need to do, and because I'm always looking at the futures, I tend not to look at. So I just need to get the spot price up in here, which should be. Let's see. Well, actually, you know what we can do? This might be helpful. This is the equity traders variation. This will give us some perspective. Let me get rid of the futures, which are incomplete here. And I need to make that line a little thicker. I don't think that's really visible, so let's do that.
Is that the little red one?
Yeah, we'll make the red one. It's orange. We're going to make that a little bit bigger so we can kind of see what's going on.
Okay, that's better.
Yeah. Okay. So, yeah, this is really what we're looking at here. So this was that peak that we saw in oil prices back in 2008, and we saw volatility get extremely high. We're nowhere near those levels now. I mean, certainly not on an inflation-adjusted basis, right? So we did get to a 119 spot 46, not this past Sunday, but the Sunday prior overnight.
Yeah.
But $2008 were not the same of $2026. So on an inflation-adjusted basis, it would need to go much, much higher than it is right now to get back to those nearly $150 a barrel highs that we saw back in 2008. But I just wanted to get your thoughts on what you think the implications for the market of what's going on right now in oil might be, and also what your thoughts are about how long something like this might last. You probably didn't see it, but I talked a little bit about this yesterday, so I just wanted to hear your thoughts before I shared my own.
Yeah, well, everybody is concerned about the Straits of Hormuz, of course, and the slowdown or the stopping of vessels going through. I've read that Turkey and somebody else is being allowed to bring their ships through at the moment. I even wrote a piece on this about Mosaic, because about 20%, everybody talks about oil, but about 20% of the world's fertilizer goes through the Straits of Hormuz as well, because natural gas is a component in fertilizer. And places like Saudi Arabia have, boatloads of literally of phosphates. And so it's a huge producer. People don't think of Saudi Arabia as having a lot of minerals other than oil and gas, but they've got a company called SABIC, Saudi Arabia Basic Industries company. We used to, when I was at ANZ, we used to do some business with them, finance tankers and mining operations and things like that, as I recall. We did something with them. And, they're a huge company all by themselves. They're only dwarfed because Aramco is the largest company probably in the world by real assets, not by necessarily market cap, but by real assets. Although with the new high prices in oil, maybe Aramco does become the highest in terms of market cap in not too long. But the issue for me is everybody's saying, oh, 20% of the oil goes through there. It's a big problem, stuff like that, blah, blah, blah. All true. But what I see is the same kind of problem that we had with the general supply chain when they shut the world down because of the COVID scare, when governments locked everything up. So you can't go do business. You can't make anything. You can't do anything. You got to sit down and bite your tongue. The same thing is going to represent a problem here, because right now, in terms of people getting the volumes of oil that they need, is not a problem because it's in transit. There's a huge amount of storage in transit. Lots of ships have been passed through the Straits of Hormuz, and they're on their way to whatever their destination was. So the longer it goes on, the emptier that supply chain is going to get. And this is why I was looking at the vol surface of oil, because I think it's really interesting on what that looks like right now, because it's super high short term. The term structure is very inverted, so short term it's very high, and I think long term, going out a year and a half, it's still, the volatility is still something like 50 or 60. It's still very high.
You're looking at the vol of oil,
Yeah.
or you're looking at also the term structure of crude, which I think is interesting too.
No,
I have that one
I was
up.
looking at the term structure of volatility.
Okay, I'll pull that up as well.
If we look at going out like a year, I think it's still like up around, what is it?
So as we get out to, and actually, you know what I should really do here? I'm going to just show where this was
Okay.
before all of this took place. So let's go back to, why not? Why don't we go, we'll go a couple days early. One of the things I noticed was that oil was ticking up pretty significantly even before those strikes took place.
Mm-hmm.
We can kind of see that in the vol surface here. So let's go back to, maybe the best time to go back to would be before the comments that Trump made. Here we are. This, I think, is probably reasonably illustrative of what we're talking about. So this is the last trading day. And actually what I should do is let's just take a look at the 50 delta options instead of the call options. Okay. So these are the at-the-money options in crude, and their implied volatilities, term structure. Now, you'll notice that the red line here, which I'm highlighting, extends further back, and that's because we're looking at it further back in time. So as of the end of December 25th, this was the vol surface for crude going out until January of 2028.
Okay.
So that's going to be this region over here. And it's interesting to note that in that area, the implied volatility hasn't changed so much. But in the near term, it has changed markedly.
Yeah, a lot.
It's kind of hard, actually, I would say, to, you look at this, and if you're not used to looking at it all the time, it's possible that you would look at this and it doesn't seem as profound as it actually is. But implied volatility going from 30, which is where it was for May 2026 at the end of last year, to 100, which is basically where it is now, this is a big, big shift.
Yeah.
So one of the things that the implied volatility surface can tell us is when the options markets are anticipating that things could potentially calm down. Now, there's kind of two parts to this, because we also need to understand that a little better. We also need to look at this chart, which is the term structure for the futures.
Yep.
And one of the things you're going to notice is that this area right here, and you'll actually see these little triangles popping up in there from time to time, because this is a live chart. So when one of these contracts trade, you'll see it light up. I don't know whether that comes across on the screen. If it ticks up, it'll show a little green triangle. If it ticks down, it's going to show a little red one. So you can sort of see what's going on. In general, it does look like the prices on the most recent ticks have been softening just a little bit. One of the reasons that the implied volatility for midsummer still remains quite high is because those futures also remain quite high.
Sure.
What that tells you is that even if everything normalizes, and even if it happens quickly, those things can still be quite volatile, because the prices right now are sharply higher than they were just a few months ago. I'll go back 6 months and we can compare once again. So here we are, mid-26. This is the region that we're looking at. This is where the futures were 6 months ago, down here around $62. And this is where, for example, this is the August future, I believe, right here. That's at, where are we now? $85 a barrel or thereabouts. So this is a pretty big shift. Now, I happen to check. There's 150 oil tankers, I've referenced this before, that are probably stranded or trapped in the Gulf.
Yeah.
Just so we have a sense of how much oil that is. This speaks to what you were just talking about, Mark, which is the amount of oil that is actually inside of the supply chain, inside of logistics for distributing oil. And that represents about 132 million barrels, which is 1.3 global sort of consumption days. We also know that there's about, 20 million barrels that flow through the straits each day. So if we think about it that way, that is 6.6 days worth of oil that normally goes through the strait that is, supposedly stranded at this point. The interesting thing is that, and I don't know whether where we stand on this now, but the Trump administration has indicated that they were going to, as sort of a retaliatory measure, if Iran did not allow tankers to transit the strait, that they would then turn and destroy, I think was really essentially what they threatened, Iran's oil facilities. So essentially, you threaten us with economic harm, and we'll return the favor.
Yeah.
What do you think of that as a strategic move? Because of course, if you take Iran's oil offline, that it's still a global commodity. So we know that they had a lot of sanctions. We know that a lot of that oil was flowing to China, and we know that China has a very large strategic stockpile, and that they may have prepared a little bit for this.
Mhm.
But at some point, that lost production, if it is indeed lost, would need to be picked up elsewhere. So
Yeah.
that's going to have an impact on global oil prices, won't it?
Yeah, so that's what I was speaking to. So there's been a number of articles that various countries are releasing a little supply from their petroleum reserves, and I guess it makes sense for some of those countries to do that. Probably it's a little, I would say probably a little premature. It's like, okay, let's wait until the tankers you were expecting to arrive don't arrive, then start um, moving money out of or oil out of those reserves. Try to fill in the supply and not focus on price, but focus on quantity. The one problem of going too early and too aggressive is that if you deplete your reserve, then you're uh, then you're out of bullets, and you can't continue on if this goes on for some time. And I'm one to believe that this will be just another quagmire that the government gets us into, and it's going to go on for a long time. My view has been so as a result. My view is even if they were to end this thing, let's say in a couple of weeks, I don't see the price of oil getting down, certainly not to where it was before this started. What was that, 65-ish kind of bucks?
Well, as in mid-December, it actually hit 55.
Yeah.
But yeah, I mean, call it $60 a barrel
60.
is a sort of a round number, would not be an unreasonable way to think about it.
Yeah. So I wouldn't expect the price to get below 75 until the supply chain, if you were, was replenished. That there would be tightness that would just take a while to overcome, and that would just require time. I don't know how much time, but it just depends how long this goes. And so to me, that's sort of the best case scenario. So if somebody were to ask me what the vol surface would look like or the skew would look like, I would say it probably would look like an inverted skew where up potential higher prices would have a higher vol than lower prices. And I don't think the world is lined up that way, but I think that's the way I see well, a little bit, I guess.
Yeah, I mean, this is interesting. I mean, it's not uncommon for commodities to exhibit. So just so everybody knows, puts are over here on the left, calls, I'll put that in green, or over here on the right. Oops, I did not put that in green, but you get the idea. So we can see that calls are trading at a notable premium to puts. That's actually pretty common in the commodity space, and the reason is because in the equity world, the risk idea is that there can potentially be, some kind of a washout and risk off, and suddenly stock prices fall. In commodities, when people think about risk, generally the risk is that there is a supply-demand imbalance, typically exemplified, the pandemic plunge being an exception to this, typically exemplified as a supply shortage. So the more you have a commodity that it is difficult to fill in a supply shortage in the short term, the more positive skew the options will typically exhibit, because the risk that options traders observe is that you could get price jumps. When we think about skew, the way to think about it is, what is the risk of a price jump? And a price jump doesn't mean a jump higher. It just simply means a gap. Whenever prices are discontinuous.
Yeah.
Because options prices use the assumption that pricing is continuous, but in the real world it isn't. It's one of those simplifying assumptions that the models make that aren't necessarily borne out by the reality of the situation. Now, it's interesting that you mentioned that you used the word quagmire to describe what we're currently in. And yesterday I did a live stream, and I highlighted this table that I created for an article, which we'll make sure to put on the Options Edge website. For those who are subscribers, you'll get this. But in it, I basically came up with 3 scenarios. This is a very simple table, and I want to say that in particular, with respect to the worst case, there is presumably a worst case in this one. But this was what I did. I just basically came up with 3 simple scenarios. The best case scenario, which I assigned a 20% probability, was that the Islamic Republic of Iran would collapse quickly, that there would be some, working negotiation with the United States to cease, the conflict, basically a ceasefire, that the strait would reopen, oil prices would stabilize, and, the administration would be able to, describe it as a success. My expected case, which is a much higher probability, as you can see here, is that, we were going to sort of continue, and I don't even know for how long, but that this would drag out as kind of a low-level conflict, low-level asymmetric conflict. Iran's leadership, whoever is leading the country at the moment, obviously knows very well that they cannot confront the United States head-to-head. And this should not be a surprise to anybody, because they have not been confronting their enemies head-to-head for the last half a century. Instead, they've engaged in proxy wars. They have sponsored terrorism. It's sort of been this perpetual, simmering, asymmetric military conflict. You can't really tell if it's on or off. And this, it strikes me as something they've been engaged in for a long time, and they could keep us sort of tied up in this for quite a while if they choose to, assuming that the leadership doesn't fall from power in that country. And considering they have all the guns, and considering they're in that position right now, and I don't really know what the attitudes of most Iranians are, but presumably they have a measure of support from some quarter of the country, and others may just simply be hoping for a quick and speedy resolution to this, and really just want to live their lives. And so, unarmed and otherwise ambivalent, neither a friend nor foe to the United States, may not be able to do much. So, and then of course there's a worst case, which is, I assign about a 25% chance to that, which is that, things actually get worse than they are right now. That could mean all kinds of things, but it could mean much more significant and prolonged disruption to, energy, to fertilizer, as you rightly point out. And ultimately, I think that would lower the position of the United States globally if that were to carry on too long. And it's a bit concerning that right now, NATO allies are not really deciding that they're going to stand side by side with the United States in this. I'm not sure that they were necessarily consulted more than it simply advised that this was going to happen, so that might be a part of it. The other is that perhaps they didn't necessarily feel that the strikes were warranted or needed at that moment. There is a counterterrorism expert that was working in Washington named Joseph Kent, I believe, and he sort of very publicly resigned today. Let me just make sure I have that name correct.
I saw a counterterrorism guy.
Yeah, he's the director of the United States, or he was until today, the director of the United States National Counterterrorism Center.
Yeah.
And I've actually seen interviews with him on various podcasts, I think, before he took that role. But, you know, that kind of thing isn't likely to, you know, to bring those that the administration are hoping to their side to try to confront what's going on in the strait to do so. Because I think as people who are looking at this, whether it is the administration's own opponents inside of Washington, or whether it's the nation's opponents in the Middle East, or countries that may or may not decide that they want to participate with us, when they see these types of things take place, it probably encourages them to stay on the sidelines rather than step into the fray. They get, you know, they have an increasing, I'm not going to call it an excuse. It could actually be a legitimate reason. I don't have all of the data to be able to say it. But it does suggest that, you know, we're not going to have a lot of support in the region soon.
Yeah.
Now, I have a counterpoint. I'll ask you this. If we don't get international support, and if the administration does not have national support, does that improve or increase the likelihood that the military engagement itself will end sooner?
That's a good question, because it's typically not in human nature that people admit mistakes, right? And the worst of that is governments. Governments never admit they get anything wrong. The average bloke in the government thinks they got the COVID response perfectly right, you know, to 8 decimal places, when in fact that was one of the greatest stuff-ups of all time. So I don't think I don't see any scenario in which this ends fast, because it's not in the Iranian government's way of acting that they're going to give up what they want to do. And you know, it's funny. I was reading an article many years ago, or not many months ago, and it talked about war. And back in the days when we were on the gold standard, wars would go on until somebody ran out of gold, because you couldn't pay anybody anymore. Couldn't buy whatever spears and bows and arrows and whatever things that they had. When the money ran out, it was all over. And today's modern era of paper money, you just keep borrowing money and you keep making stuff and keep hurling it at the other guy. And so things can go on a lot longer. I mean, who thought we would hang around in Afghanistan as long as we did? And then the exit, of course, was a disaster. But
the Russians probably believed we would, because they had been through their own exercise in Afghanistan when they were still the Soviet Union. So anybody who was old enough within the former Soviet Union to remember their engagement there probably said, "I've seen this movie. I saw the prequel, or I saw the first movie, so I kind of get a sense of how the second one. This is you know, Predator 2 or whatever. This is gonna be ugly."
They were probably laughing. It's just saying like you learn nothing over there in Washington, D.C. So
it does seem that way at times, doesn't it?
Yeah.
Well, here's the thing, though. I mean, what about the possibility that the president simply declares victory?
It's possible.
Says, that's kind of that would be a good way to.
Yeah, we did what we wanted to do.
Well, yeah, I mean, to basically, that would be a way to sort of declare success without admitting it was a mistake.
Yeah.
And it strikes me that if the incremental gains that are going on now from one day to the next are small, that almost couldn't happen too soon. It does feel to me that the president has not really shied away from sort of sudden pivots in the past.
Yeah.
I'm kind of hoping that's what happens here. Would that be your hope too?
Yeah, I would hope this is over very fast. I was not happy when I heard this was going on. Um, you know, one of the reasons why people wanted an alternative to then a career politician, you know, is a lot of us don't like the Leslie Grahams of the world, where, you know, people want to go to war all the time and for whatever reason. And yeah, there's lots of things that we don't like about what's going on, and I certainly didn't like the way the government oppressed people in Iran, and particularly the way they would treat women. It's you know, it's a crime, and it shouldn't happen. The question is should Americans be spending their money, and should we be sending kids from the Midwest of this country over to go fight wars like this? And I've been against it, especially, you know, I go into the town where Wyatt was born, and to get into the hospital and stuff, you drove by the cemetery, and it's a small town, you know, 20,000 people or something like that. And the number of American flags in the cemetery was just overwhelming. And yes, where they grant the kids to go do this, and I don't like it. I don't like it at all. So I hope it's over fast. I don't really care if we lose face or not. I don't want to spending our money. I don't want to sending our young people over there to do that. But I want to get back to talk about skew a little bit before you move on. Can you compare USO with that's the ETF, the oil ETF?
Yeah.
I use a service called.
Are you looking at options prices?
Look at
you want to look at skew or
skew, and we'll go out. Let's look at term structure.
Okay, I'll look at the term structure first.
Yeah. Now, can we look at that compared to, because I think this is for some reason higher than oil futures, and I was wondering if there was a why that might be. Can those be compared, the futures versus USO?
Yeah, so if you don't mind, can I give a little bit of an explanation for why that is? Okay. So USO is it's an exchange traded fund, as I know you're aware. USO and its natural gas compatriot, UNG, the U.S. Natural Gas Fund. So the U.S. Oil Fund and the U.S. Natural Gas Fund, they get exposure to oil and to natural gas by trading futures, forwards, and swaps on the underlying. Now, one of the things you will observe if you take a look at, and actually this is why I want to bring the term structure back into this for the futures, which I had up earlier. Okay. So when you are looking at the forward implied volatility for a commodity futures term structure, you are looking at the implied volatility of the respective future. So for example, right, you are looking, if you're looking out to October of 2028 in this case, you are looking at the volatility of that futures contract. Now that is different than the term structure of volatility for a rolling bunch of forward contracts, okay, which is what USO is. So the way to think about USO is it is a synthetic construct of always adjusting but relatively near-term futures, forwards, and swaps. Whereas when you are looking at the term structure for the commodity futures, each of those are individual futures. What do we know? Well, one of the things we know, the price of the futures already imply this, that the front end is much more volatile than the back. So those volatilities are a function of how much they expect those futures to move. In the case of USO, the underlying is the ETF itself. So even if you expect volatility to drop in the future, those options still have the underlying of the current futures and forwards that are comprising the ETF itself. Right? So you will. This is one of those important dynamics, and it's one of the things that is really important when people trade VIX futures and VIX options as well. So, for example, I've seen people who thought, "Oh, the VIX is 25 right now, and I can buy a 6-month VIX call option, the 20 strike call, for say $2.50." And they say it's in the money by $5. No, it's not, because that long dated option, the underlying is not spot VIX, and it's not the front month VIX future. It is the respective future out in time, and the same thing is true for these. So the important thing to understand when one compares an equity instrument that uses futures to the futures themselves is that the options on the equity are for that one underlier, but for the futures, they're not.
Okay, that makes perfect sense.
Okay. So, and I realize that's not, like, for a lot of people that's not intuitive. I mean, obviously I traded this complex. I was a former NYMEX guy, traded oil, gas options on these futures, and then of course the largest trade I ever did was in U.S. natural gas ETF. And I ended up trading the futures against it, but we traded 250,000 contracts as part of one trade in that thing. That was about 18 months, I think, before you and I started at CRT. But I think it was, in strict contract terms, it was one of the largest options trades that had been done that year.
Yeah. Cool.
And the other side of that trade was none other than John Arnold. So you can look up John Arnold and see who that is, but probably the most successful natural gas trader in history, much to my chagrin. Okay. So this was what I wanted to ask you next, which is, how does this translate to equities? Because more people are probably trading stocks or have positions in stocks than they do in USO, and even fewer in oil and gas futures, and certainly not the underlying.
Yeah, well, I'm kind of looking for stocks to have a sell-off, and maybe this is the kind of thing that gets the administration to declare victory and go home. Because I'm looking for stocks to fall, sort of like they did back in late December into, what was that? The low was April, and
April we had the Liberation Day stuff. I think we actually fell into an intraday, not a formal, but I think we actually had an intraday bear market. Now, this is really interesting that you mentioned this, because I saw a big trade today. Yeah, so there you have. The intraday low was down peak to trough, 21.35. So formally, the way people tend to think of this, a bear market.
Yeah.
A correction is a decline of 10%. A bear market, decline of 20%.
Yep.
Now, why do I say it's so interesting that you say this? It's because the trade that caught my eye today in the SPX options was the following. It was I'm going to just pull these up, and I'm going to put these expirations in so everybody can see it. So it was the May 1st. Look at this. Check this out. Right here, there's a lot of information on it, but what I want everybody to draw their eye to is right here. May 1st, 5,300. May 1st, 5,200. Looks like somebody bought 45,000 of the May 5,300, 5,200 put spreads in SPX. And as you can see, these things only trade, they're trading relatively close to one another in terms of price. The 5,300s today, all of those contracts traded for an average price of $11.60, round numbers. Oops. And the 5,200s traded at an average price of, let's see here. Oops. What did I just say that number was? 1160? Is that what I said? I think it was.
I
think I said 1160.
I was concentrating so hard on the screen.
1160 and 1032.5. So let's just call the difference between those things $1.28.
Yeah.
So that represents 128 times 45,000 contracts, an outlay of about 5.75-ish million. It was slightly less than $1.28 per spread. So about 5.75 million. But the important point is two things. Number one, that spread could potentially be worth $100 at May expiration if the S&P falls to the levels that you're talking about. So if we test, it doesn't even have to go that low. So in the post-Liberation Day low, the S&P fell to 5,000. If it just fell to 5,200 or below, this put spread as of May expiration would be worth its maximum value. 45,000 times 100 is $45 million because there's 1,000 multiplier on it, right?
Yeah.
So somebody's basically risking 5.75 million in premium for something that will pay them 45 million in the event that we actually formally get to bear market territory. That's approximately where that lower strike is. That's just more than 20%. So it would seem that at least one institutional market participant maybe doesn't agree with you, but at the very least believes that it's enough in the frame that it justifies spending nearly $6 million in premium to insure against it.
Yeah. See, I can visualize that time frame because right now people are concerned, but they're not scared. Let's say. But I can see if they come to the realization sometime late this month, let's say 2 or 3 weeks from now, that, oh, this thing is going to go on much longer than we think. Oil prices are going to be higher for longer. No more Fed rate cuts. In fact, maybe there might even be I can't imagine a rate hike, but you could see market psychology starting to shift. And then people sort of put on their bear hat for a little while and get a sharp sell-off. And then maybe that's the kind of thing that gets the administration to say, okay, let's claim victory and move on. And
this is a 1-year chart, basically. So that's the level where that white line is that we're talking about.
That's equal in percentage terms to what we saw before?
No, not in percentage. Not in percent. Well, let's take a look at the percentage terms. It was 21. It was a 21.5% decline that we saw, right? Peak to trough.
What's 21?
And in this,
what's the same?
And in this case, I will take it down to 20. Let's see. Actually,
is that 21% down there?
That's about 21%. Yeah. So not quite to 5,200.
Yeah.
It was 21.5, but it was darn close.
Yeah.
And it was below 5,300.
Right.
So a percentage move comparable to the one we saw in the post-Liberation Day sell-off would take us down to a level that would be in the money for that put spread, if not quite to the short strike. And one of the things I would offer for folks is that this does illustrate that if you're looking for tail risk insurance, something like that, something like a put spread in SPX can be a reasonably interesting approach. So those put spreads, $1.28 a piece, $128 per SPX put spread, $100 spread on SPX. It's a $100 strike difference times 100 multiplier is 10,000. So you would be spending $128 for something that could be worth $10,000 if you fall firmly into bear market territory as of the expiration of the option. So, use this however you will for those watching, but I just want to point out that there is, here, Monday Morning Quarterback. I noticed the SPX futures prices for March, expiring Friday and June, are drastically different. Is this due to the cost of carry? That is usually the difference. And I guess one of the things we could do is take a look. So the cost of carry is going to be influenced. So the cost of carry is partially rates, and that has a much bigger impact now than it did in years past because we were essentially at ZIRP, right? So when interest rates were zero, the rates didn't really factor that much into it. But that doesn't mean that there wasn't a material carry cost anyway. There was. That carry cost, though, was going to be driven in the zero interest rate environment principally by dividends. So let me just see when the next dividends for most of these stocks are going to be coming out. So let's see what the next X date will be. No, next, I want the next one here. Well, I guess I can I'll just do the last one, I guess, because it doesn't look like this is
Why don't you do it?
Yeah, I just want to do this. So we're going to do the dividend X date. These are typically going to be about 90 days apart, right? So let's take a peek, see what we get here. So if you're looking, say, from today, which is the 17th, so I'm just going to go from, say, the 17th, So what's going to end up happening here, if you're, say, looking at, from one future to another, these are all previous dates, but let's just see. So you're going to end up with dividends in a lot of stocks in the S&P, as you can see here, right?
Yeah.
And if you own the underlying stocks, then you get the dividends. If you have a future or an option, if you have options on those stocks, or if you have futures on the index, you don't.
Right.
So that also is going to be an important carry cost consideration. So when you look at it, you can kind of see what that is. And actually, if we look at the options chain, it should show us what the anticipated, what the forward is. So we can see that baked into the cake here. So, for example, let's see if I can find a spot where the forward has a pretty big distinction, 67, 20, 74. I'm going to just go down to a minimal number of strikes. Let's just use 3 strikes. All right. And so you can see the forward over here on the, it's the last thing. So this is the forward price over here.
Yeah.
And that's going to be a function of both the implied dividends, which you can see over here. The options will factor in the implied dividends, and it's also going to factor in the rates. That will give you the implied forwards. And the forwards in the futures and in the options markets should align pretty closely. If there's any kind of a big divergence, then there's probably an arbitrage. But yes, to answer your question, when you see that, that is going to be a cost of carry, and the cost of carry is going to be a function of those things. And I will add that for people who trade things like the S&P or the FTSE or the DAX and all of these indices, we used to trade a lot of variance on these things. So we would trade long-dated straddles on these indices around the world. We trade a lot of variance swaps on it. One of the other things that we would trade were dividend swaps. So people, they'll take a volatility bet, but then they'll say, okay, well, I don't want to get too offsides on the dividends. So they'll even do a dividend swap. You can actually end up, stripping the various components of an options or a futures price out in time, and then, just trade that aspect that you like. Okay. So, you know what I should probably do, and I think what I will do, because I know that some people who are watching probably don't trade SPX options quite as frequently as I'll build this out in options play.
Yeah.
I know I updated that password yesterday. It just will not update. I went right into it and edited in the password manager, and it did not stick. So every single time I have this stale password. Okay. But we can do the same thing in SPY, and I'm just curious to see how closely it matches in SPY what the prices were in SPX, because there will be comparable expirations. So we'll just, oh, it was already in SPY, so I didn't actually need to reload that. So I'm just going to go out in time. We're going to choose the May 1st, and that was the 5,300, 5,200. So I'm just going to use something comparable. I'll look at the 530, 520 put spread. There we go. Look at that, 13 cents. So that's equivalent to $1.30 in SPX. So it's priced almost exactly where it was. So this is the kind of strategy one could potentially look at if you're looking at that tail risk. You will notice when you do this that options plays scoring metrics don't like this very much. Why? Because it has a very, very low probability of profit. But that is not really the exercise when you put on a tail hedge like this.
Yeah.
You're not putting on a tail hedge because you expect it to pay off. You're putting on a tail hedge hoping it never pays off. That it never gets close to paying.
Probably, yeah.
But you're buying it because you can't stomach the pain if it does. And, I don't want to... I've said this before. I actually even said it in my article too. I don't want to get into like a big political rant one way or the other. But I'm with you. Rarely do we get involved in military engagements, and it's on all metrics, it's a success.
Yeah.
One of the things that I had suggested out of this, and I'm curious to hear your opinions about this, is that it was really not that long ago that Europeans needed to be reminded of their very desperate need for energy independence. They pivoted away from nuclear power in Germany a number of years ago and started to rely increasingly in Germany and other Western European countries on energy provided by Russia. And the risks of that came clearly and painfully to light when the Nord Stream pipeline was sabotaged. To me, this is another reminder, if they needed any, which they should not have. LNG is more than 5 times as expensive in Europe as it is in North America. Yeah. My thinking is that they have to seriously consider getting back on the nuclear power generation bandwagon. And if they do, I would think beneficiaries of that could be GE Vernova, Cameco, URA, things like that. Do you think, am I just totally out to lunch? Am I the only one that sees things this way?
Well, the problem with nuclear in the West is the environmental part of what to do with nuclear waste. So after you run your reactors, and you've depleted the uranium, one dirty little secret most people don't know is a lot of depleted uranium gets turned into weapons, and they use it for tank busters. And they coat them in that very heavy and dense, and they pierce tanks and wreak all kinds of havoc. The French used to be very good at recycling because they would take the nuclear waste, they would recycle it, essentially extract what fissionable material was left, and separate that from the benign material, and then keep using that over and over and over again as they mix it with new production. And so they would end up with very small amounts, relatively speaking, of nuclear waste. So it's kind of a shame that they kind of backed off on that. There's a chart up on Twitter I saw this morning, and it showed the comparison of Germany taking its nuclear power essentially down to zero, and then China taking it from nothing up to like 5 times what Germany was doing in the same time period. And we're going to go back and start doing this again, but the way we're going to do it is with small reactors, these 300 megawatt reactors. So instead
You like NuScale then,
yeah,
like SMR?
yeah, supposedly they're much safer. Instead of building these 2 gigawatt facilities, you can string together these smaller facilities, which are supposed to be much safer. 3 Mile Island really scared the Jesus out of everybody in the States, even though nobody was harmed with 3 Mile Island.
That and the movie with Jack Lemmon,
Yeah.
the China Syndrome.
Yeah, that's the thing that brought everything to a screeching halt in the U.S. And
well, I think Chernobyl also sort of scared people a little.
My cousin finds engineers and stuff like that, and knows just a boatload about the development, construction, and operation of nuclear power plants. And he runs a shop that finds jobs for engineers, technicians, nurses, all kinds of people in technical fields. And he's been reactivated. He's getting tons of business from people that want to re-explore what's going on there. I almost went to work for a nuclear facility down in Arizona. When I was working I was working at Fluor Engineers at the time, doing construction, and we didn't necessarily.
Fluor is part of my 2026 acronym on CNBC, the Engineering, Procurement, and Construction Company. And this was part of my thesis for it, which is that they are well known for nuclear plant construction, commissioning, decommissioning, recommissioning.
Yeah.
They did own a significant interest in NuScale Energy, ticker SMR, which they either have or are about to divest from or monetize. It's interesting. I was just looking. France generates somewhere between 65 and 67% of their total electricity from nuclear power. And you mentioned that they degrade more enriched fissionable material for fuel by mixing it, reprocessing.
Yeah.
And what is interesting is that an Iranian minister who was being interviewed just within the last several days suggested that one of the things that they admitted, by the way, they admitted that as a part of their negotiation technique that they said that they had 440 kilograms of highly enriched uranium. Now, they said this should not have come as a surprise to anybody because that was what the IAEA had already reported, I think, about a year earlier, right? So their point was they weren't trying to flaunt it. They were simply saying, yes, we this, we have it. So we're going to begin with, we have highly enriched uranium. One of the things that got mentioned was mixing highly enriched uranium and essentially degrading it, but to a level at which it would still be sufficiently enriched as a nuclear fuel for other purposes. So it was interesting that you mentioned that is how France reprocesses so much of their fissionable material, especially the degraded material, mixing it presumably and combining it with more enriched grades, so that essentially you just keep running the stuff through the reactors, right? Is that basically the idea?
Yeah. So the fissionable material is a small percentage of there's U-235 and U-238. They're blended together, and the fissionable part is a small percentage, and then it gets burnt up, and then you're left with some waste products and a small trace of the fissionable material. So you just run it through the centrifuges again, concentrate it back up, store some of the stuff that's benign, and so you've got something you can put back into the reactor and essentially burn again. And you just keep doing that until huge masses are just down to a small amount, and you don't end up with nearly as much fissionable material. Now, it's interesting you say that by blending you knock it down. Well, that's how the U.S. got its nuclear materials for a long time after the war fell down, because Russia needed cash. So Russia would take some of its weapons, take the nuclear material out, and blend it out,
Sell it.
and sell it to the U.S. And we used that for decades in our reactors here in the U.S. Most people didn't know that, but they had way,
I did not know
they
that.
had way more nuclear weapons than anybody could possibly need. So they monetized some of it.
Bombs to plowshares?
Yeah.
Swords to plowshares. I
Swords,
think that's
yeah.
Yeah. I'm mixing metaphors here. Well, really interesting and stimulating conversation with you, Mark, as always. Thank you for joining me on your spring break holiday.
We've got
I can see that Wyatt has decided to join us. I guess he decided that the conversation about
nuclear weapons,
nuclear power was just too compelling.
Too compelling.
And he had to.
Yeah. Bluey had to go. Bluey had to go, like, take a rest.
It gets much better than any cartoon that might have been on in the other room.
Yeah.
All right. Well, Wyatt, you rock away there and enjoy your day. You enjoy your week off, or it's probably only a partial.
I'll be
week
working
off,
I'll be working right here all week. I gotta.
Yeah, teaching isn't one of those. Yeah, teaching isn't one of those things where you ever really quit if the semester is still in session.
Yeah.
But as always, a very interesting and conversation, and I'm looking forward to having another one.
Okay.
If you're available
Next week.
This time next week. Yeah.
All right. By the way,
well,
I had
everybody
a new light for that office, so you should be able to see me a little bit better in my office.
Oh, nice. Okay. Well, we're looking forward to the new you.
All right.
And to everybody who either watched this live or who may watch a recording of it, please give it a like and a subscribe, and put your questions into the comment section, not the chat, of course, because that ends up going away. But if you put your questions in, and if we see those with enough time that we can sort of see where people's curiosity lies, Mark and I might be able to come up with more interesting collateral to support whatever answers we give, right or wrong. So, Mark, as always, thanks very much. And to all of you watching, thank you as well. We'll see you next time.
Okay.
Thanks for watching.
Have a great day.